Joining me now is Sam Lessin. He's a general partner at Slow Ventures. You're supposed to extol the virtues for society of venture capital, Sam. What's happening?
Look, I'm a huge believer in venture capital. That's, my profession. We do it at an early stage, seeding companies from zero and hopefully delivering some big returns as we have. I just think we've gone to live through an interesting period where, especially late stage capital, the funds have gotten so big. What we've seen is they're competing with the public market. So the best companies they keep private, because why not put more of their own money into them? And we've seen this continued march from Chamath SPACs on through of IPOing all the trash. And it's not surprising we get a little bit of lack of trust here.
Right. And so the question, though, becomes, is if the retail investors kind of once burned, twice shy. And Smile Direct was an IPO, I think, in 2017. So to the larger discussion we're having about this flip in markets, this is not just the COVID and post-COVID IPOs. We're talking about companies that went public 5, 8 years ago, in some cases, all during this kind of zero interest rate era.
Yeah, look, I think the big picture, there's a bunch of reasons why a bunch of consumers look at IPOs recently, especially tech ones, and say big meh. With the AI trends, et cetera, it's very easy to buy the big names, which there's no upper bound on valuation anymore. So why not buy more Microsoft or Meta or things like that, where the impact is clear? But the bigger story is just, historically, the private markets for capital were small. The IPO was the destination, right? And in that world, they served a really useful purpose, kind of pulling companies along until they were big enough and in a good place to IPO. What we've seen, though, is that the private markets and private market capital have gotten so big that why not take a Stripe or a Canva or any of the really high quality private companies and keep them private basically forever, keep doubling down, own more of them. And then what gets IPO'd? What gets IPO'd is it is the Virgin Galactics via a SPAC from Chamath, putting trash out in the market. It is the BuzzFeeds, the Blue Aprons, the Rent the Runways, all these companies that they were fine shots on goal, but they weren't great companies, right? But if you tell the public markets over and over, this is the product we're offering, at some point, if you're a retail investor, you say, why would I bother, right? This is clearly an adverse selection problem.
So I wonder what happens next, because the exit is so important for venture capital, for private equity, for, so many parts of this whole ecosystem. Does that exit just become selling to another firm and still able to kind of realize those multiples? And also, does that then mean, like you said about the public markets, do we worry about the quality deteriorating over time, or was the real worry when all of this stuff was kind of getting in there in the first place?
No, I think you've got it exactly right. If you look at the history of private equity, there was a long time, I was actually even working early in my career when the idea of a private equity firm selling to a private equity firm was verboten, right? You sold to the public market. And that's obviously completely changed. Now that's most of the business, right? As you sell back and forth to each other at higher and higher valuations as you figure things out and keep the good companies private. I think that's certainly the case. Venture capital hasn't gotten there yet. But you could totally see the trend line moving in that direction in terms of where it goes and a splintering of the markets. I think it's terrible for capitalism, candidly. I think it kind of hoards the returns to kind of people who can afford to be in private funds. I think it really hurts the public market. And I do think there's a real threat long term that you end up with this dual class world where, sure, the trillion-dollar companies are public. Sure, public market investors, there's a certain scale that private capital can't reach, and that's kind of what the public market is. But the vibrancy of the young, open, free public markets, that existed pre-Sarbanes-Oxley, pre-kind of market reorganization is just gone.
And the thing that I worry about is, because you're exactly right, but if the industry takes these arguments to Washington as a way of saying this is why you should open up access to more individual investors to private equity or venture capital, for private equity in particular, right now is kind of the worst point in the cycle to do that, because it had such tremendous growth. It's now seeing pressure on returns. It owns a lot of highly leveraged small companies that may not survive this environment. So, even if you're right for the next generation, if they open those floodgates right now, you feel like people would now get sucked into those industries, maybe after all of the best years have been had.
Yeah, I think there's just a lot of unintended consequences that have happened since the tech crash and since '08 in terms of how things have been. People have tried to regulate or protect investors, and we've ended up in a very sticky world. Again, wealth inequality doesn't help either, because basically all of a sudden you do have private institutions with not many LPs that can compete with the public markets, right? So there's a lot of swirling implications here. I want to be very clear. There are high-quality companies being started. There are high-quality companies being founded. We like participating in those. I'm not anti-venture capital, but we've ended up with a very weird dual-class system where, the only stuff that's making it public are the worst companies, right? And it isn't just COVID, although COVID, Chamath, SPACs, et cetera, certainly accelerated it.